All right, let's jump straight in. Welcome to today's explainer, where we are essentially putting virtual care giant Teladoc on the examination table. We're going to perform a complete health check on the company today, blending a deep dive into their incredibly strict ethical backbone with a real-time analysis of their financial vitals. If you've ever wanted to understand what makes a modern telehealth behemoth actually tick, from its internal rulebook all the way to its market valuation, you are absolutely in the right place.
We're looking into the mystery of how Teladoc is navigating a pretty massive stock slump. They were literally the pioneers of the virtual care space, but as you'll see, pioneering an industry clearly doesn't guarantee a smooth ride once you hit the public markets. We're going to examine exactly what their corporate anatomy looks like right now to answer one core question. Can they use their strong governance and a massive strategic pivot to finally treat their own bottom line?
So here's our roadmap to diagnose the company today. We'll start with their ethical foundation, check those financial vitals, unpack a surprisingly strong Q4 earnings report, explore their big segment shift, look at their chronic care strategy, and finally, forecast the road ahead.
Okay, Section 1, Teladoc's Ethical Foundation.
To really understand Teladoc as a mature healthcare player, we first have to look at what I like to call their regulatory immune system. Operating at this massive, global scale, they have to enforce incredibly strict rules around everything, from competitive intelligence to insider trading. But what's uniquely fascinating to me is their specific policy for high-profile individuals. Because they handle such highly sensitive health data, Teladoc strictly prohibits their workforce from exploiting non-public information about professional athletes or public figures for sports betting. Think about what that actually means for a second. It just proves how intensely they have to guard their operations in today's culture.
And beyond the human element, they have to police their technology too. As they scale up, they've rolled out a really robust, responsible AI framework to make sure their algorithms remain totally unbiased and safe. Because in healthcare, AI isn't just some fun tech buzzword, it's a tool that requires immense oversight. They've committed to 5 core pillars: accountability, fairness, transparency, reliability and safety, and of course, privacy and security. Protecting patient data is literally their absolute priority.
Furthermore, because they provide services for U.S. Medicare and Medicaid, they have to operate under zero-tolerance federal statutes regarding fraud, waste, and abuse. This is what proves they are a highly regulated medical entity, not just some tech startup moving fast and breaking things. They have to comply with heavy-hitting regulations like the False Claims Act and the Anti-Kickback Statute. Every single claim they submit has to be impeccably accurate. So why does this matter to us? Well, because the structural integrity is vital. Just one major failure here could mean exclusion from federal healthcare programs entirely. That's a mistake that would instantly cripple their business.
Which brings us to Section 2, Financial Vitals in Stock. Let's assess their market health.
Now that we know their foundation is rock solid, let's take the company's pulse using some recent Motley Fool data. Despite their absolutely massive footprint and billions in annual revenue, Teladoc's market cap currently sits at just $1.43 billion. For a company that orchestrates care for millions of people globally, that reflects some severe market skepticism. The big question we have to ask is, why is there such a massive disconnect between their huge operational scale and their relatively tiny market valuation? Well, a huge chunk of that disconnect comes down to profitability, or lack thereof. They are currently operating at a loss, showing a trailing 12-month earnings per share of negative 96 cents. Now, they do generate substantial gross profit. We're talking over $1.6 billion over the trailing 12 months. But their operating expenses have just kept them out of the black. It's a classic corporate challenge, right? Trying to transform massive top-line revenue into consistent bottom-line net income.
And here's where it really hurts for investors. The stock is currently hovering around $8.36. That is down a staggering 71% since its 2015 IPO. And if you zoom out to a 5-year horizon, the drop looks even steeper. The market has severely punished this stock as that crazy pandemic-era telehealth boom cooled off, and the company was left facing mounting operational cost and some pretty tough segment challenges.
But let's look at Section 3, a Q4 earnings surprise.
Just when you thought the prognosis was looking pretty grim, Zacks Investment Research reported a Q4 beat that breathed a little life back into the stock. Teladoc actually beat market estimates. They posted an adjusted loss of only 14 cents per share versus the expected 19 cents. And a big driver for this was international revenue, which saw an awesome 19% surge, hitting $125 million for the quarter. Plus, they are aggressively trimming the fat right now, actually reducing operating expenses by over 22% year over year to steer the ship back toward profitability.
Moving to Section 4, the BetterHelp shift.
This Q4 surprise really highlights an active strategic transition happening behind the scenes.
To understand Teladoc today, you have to realize they're essentially managing two very different business models. Their direct-to-consumer mental health segment, BetterHelp, actually dropped 6% in Q4 revenue. They've been struggling with lower access fees and a general decline in U.S. consumer demand. However, their enterprise-focused integrated care segment grew by 5%, bringing in over $409 million. So Teladoc is leaning hard on integrated care to carry the weight, while the BetterHelp side recalibrates.
This naturally leads to Section 5, the chronic care strategy. They are going all in.
This is Teladoc's primary treatment plan for future growth, going all in on integrated chronic care. Instead of just being the app you open when you have a sinus infection, they are using continuous, cellular connected devices and specialized care teams to manage long-term cardiometabolic conditions. They're doing this for over 1.1 million active members right now. We're talking providers, registered dietitians, and mental health coaches all working together. And here's the kicker. It's a real game changer. They put 100% of their fees at risk for these solutions. They are literally guaranteeing value to the health plans that hire them.
And this comprehensive wraparound approach is winning over massive enterprise clients. You can see it in the glowing testimonials from directors and major health plans, like Jess Villani of Blue Cross Blue Shield. When a huge health plan purchases this service, they aren't looking for quick fixes. They want genuine, sustainable lifestyle changes for their populations. And they're relying on Teladoc's behavioral science best practices and proactive coaching to actually deliver those results. The clinical results totally back this up. It's staggering, really. They've achieved a 66% decrease in high-risk patients. At the exact same time, they're maintaining an incredible 90% member retention rate after 1 year. This proves that once patients are enrolled, they stay engaged, they actually use the devices, and they see their health outcomes improve. For investors and industry watchers, this is exactly the kind of sticky, recurring relationship that turns a simple virtual visit into a true, long-lasting healthcare ecosystem.
Which brings us to our final section, the road ahead. We've seen the ethical foundation, the current market struggles, and this massive strategic shift toward chronic care. So what does this treatment plan mean for the next couple of years? Looking at their 2026 outlook, Teladoc expects up to $2.58 billion in total revenue. This is going to be driven by continued growth in that integrated care segment, projected to grow up to 3.9%, which should help offset further expected declines in BetterHelp. Crucially, they are forecasting a healthy free cash flow of $130 to $170 million. They are clearly prioritizing actual cash flow and margin expansion in their enterprise business over just raw, unbridled top-line growth.
So, by relying on strict ethical governance and making this massive shift toward chronic disease management, the ultimate question remains, is this the prescription that will finally heal Teladoc's stock? They have the global scale, they have the clinical results in cardiometabolic care, and they certainly have the institutional framework to operate safely at the highest levels. Now the market just waits to see if this pivot will finally translate into consistent profitability. Thank you so much for joining me on this explainer. Keep learning, keep analyzing, and I'll catch you on the next one.